I am not a financial advisor, and this podcast is for informational and educational purposes only. The content discussed here is not intended as financial, investment, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Past performance is not indicative of future results. All opinions expressed are my own. Aloha and welcome back to the week that was. I am your host, Colin Edsman, and this is your weekly market recap. Oh my goodness, what a week! Started off good, ended off crazy. Oh my gosh. I mean, I wasn't super into it. But I couldn't help but see the news. My goodness, everything from Bitcoin price action, Zcash debacle, the way that week ended off, tech had just a massive downturn. Whew. It's going to be a hard summer, I think. I don't know if we're going to be in a red summer. I don't know if the IPO for SpaceX is just going to lift us all summer. Maybe it was a sell in May and go away situation. I have no idea. But this is the first week of June and it ended poorly, to say the least. But I'm going to try something a little bit new here. I'm going to throw some music on in the background while I talk to you guys. I'm going to try to keep it a little on the quiet side, so give me a second while I get that set up. But I think it'll be a nice little calming mood for what was a very violent end to the week, especially with the way cryptocurrency ended the week. Michael Saylor did a little bit of selling. We'll get into that in just a second. I think that's a good volume. Yeah, that sounds good. All right, awesome. Let's try this today. And if you guys have any concerns with this, just leave it in the chat. I'm just trying to bring a nice calming presence. I'm realizing that it may be 8 p.m. for me here, which is not super late, but it is a late hour, so let's calm down the mood. I got the red in the background because obviously this week ended very bloody. I mean, blood in the street, and I'm talking Wall Street, of course. On a local standpoint, before we move into the major indices, there was a lot of action on our Saddle Road, which is a road between Hilo side and Kona side of the island, and there was so much accidents in a short amount of time that there's a lot of ideas on how to fix it, but it really comes down, I think, to a little bit more civil engineering. To keep it simple, we need to increase the friction in that area between those mile markers. But those are the only actual sad notes for the week. The rest is all just money, and money is honestly very trivial in compared to the things that can happen. So please drive safe, be safe. I want to keep talking to you. I want you to keep watching me from wherever you are, whenever you are. But let me check the audio here. Sounds good. This is a style of music called Adagio. It's nice and calming. A lot of times it's got an inspirational vibe to it. So please sit, hang along. I hope you're having a great evening wherever you are. So let's break down a very volatile week. Wall Street started with record highs and momentum, but ended the week with a sharp sell-off, especially in tech. Stronger than expected jobs data, rising bond yields, and a tech rotation all played key roles. Here's how the major indices did. S&P 500 closed the week around 73.84, down roughly 2%. For the period after hitting a fresh all-time high of 76.21, it snapped a long winning streak with a brutal 2%, 2.64% drop off today or yesterday, depending on when you are. Dow Jones average hit multiple record closes midweek, peaking above 51,500. Whoa. On Thursday with a big 875 point day, but gave back ground closing Friday near 50,867, down roughly 1.35% on the day. Still showed relative strength versus tech. NASDAQ Composite was kind of the biggest hit this week. It was the one that got hit the most as far as losses go. Hammered by semiconductor weakness, down around 4.7% for the week, which is huge. I mean, it had a over 4% plunge today alone, down at 25,709. The rotation was very clear though. If you're watching, you could have seen this very easily from the money flow. But we're looking at value, financials, healthcare, and industrials outperformed, while AI and tech took a bit of a breather. It kind of had to. We've seen it being in places running 20, 30, 40% in a month span, and that's just not a healthy amount of movement. Congratulations if you're on the right side of that trade, but be aware. I mean, we're going to see some money moving. Nothing goes up forever, right? I'm not saying be bearish right now and start buying puts everywhere. The VIX spiked as well, signaling some heightened fear. I mean, there was only a 2% downturn on the S&P 500, but that caused the fear greed index to go immediately from greed to neutral in like one day, which is a lot of movement actually. So I don't know what's going to be Monday. Who knows? We're getting the usual Iran's going to blow up something or attack somebody on a Friday night after close, because as we've been noticing the last few weeks or months, I don't know how long have I been covering the Strait of Hormuz at this point, but with the last few months or so, it's always war on the weekend. So we're getting another situation where we're more likely going to get some kind of turnaround. I don't know. I can't really keep my eye on it anymore. It's all over the place. The big catalyst, though, was a May jobs report. Today's non-farm payrolls came in at a hot 172,000 jobs, well above expectations, with unemployment steady at 4.3%. This fueled bets on fewer or delayed Fed rate cuts, sending Treasury yields sharply higher, 10-year above 4.5, longer bonds pushing towards 5% or higher. Borrowing costs weighed in on both growth-sensitive stocks and other equities, especially high valuation tech. That's going to be a big part of the news moving forward. We're going to kind of transition out of oil because it's going to be elevated probably the rest of the year. It may get back to pre-war pricing in your local areas, maybe 6 months from now. It seems that the Fed is already kind of pricing in this higher for longer situation, so we're going to see that for a bit longer. I was hoping it was going to turn around, but that's going to put a pretty large dampener on how people enjoy their summers, right? A lot of times people travel and enjoy their times with their family, and depending on how much the travel costs are is how far they will travel. So I can anticipate a lot of the continental US will be utilizing probably driving, right? Go to some kind of Great Wolf Lodge, I hear is great, from multiple people, from famous people to not so famous people, rich people, poor people. Everybody loves Great Wolf Lodge, so I can see them getting a lot of action because they tend to be close to people and they're enjoyable and they're not busy, and no one has as much spare equity to go and enjoy Disneyland. Another thing that's expensive is like the Knicks game. It was like $10K for seats on average. That's wild like probably the most expensive basketball game ticket I've ever heard of. But I don't follow basketball. Check me on that. That might be a joke. It might not. I don't know. I don't know if check is a basketball term. But we're going to be covering a lot of the bond market for the next few months. Mortgage rates could be above 10% within the next few weeks or months, which is a unimaginable amount of interest for a mortgage, and it's going to push a lot of first-time homeowners out of that market. And who knows where that equity is going to go, because people who are almost able to buy a home will still want to grow that net income. So we could see some oh, hi, yay, is it working? All right, good. We could see some money rotating from what could have gone into the housing market, move into some other places like, who knows, tech, or maybe they could just be investing in the stock market in housing that way. But we can't see, we won't be seeing a turnaround as far as the housing market until these bond rates come down or housing somehow becomes more affordable. But in the short term, I don't see that happening. Tech sell-off, as far as sectors go, was kind of the big highlights for the week. Broadcom, Nvidia, Micron, Marvel, AMD, and others dropped double digits at points. Concerns over valuations, guidance, like Broadcom, and possible peak in AI hype cycle hit pretty hard. Winners, though, were like financials, healthcare, and more defensive and cyclical names held up a little bit better. The broader market, though, sort of improved at times earlier in the week, but Friday's move was dominated by selling in the Magnificent Seven stocks. Now, if you follow Steph Guild at all, she has been saying for over a year that there's more to life than the Mag 7. If you're a Robinhood user and Gold member, honestly, I think both will get access to the Investors Guild. That came out today. I think we got 2 installments of that. Please go check it out. It'll give you kind of a better explanation on why the Magnificent Seven is sort of something we should treat as individual stocks for a while, because we're not seeing it move as a unit anymore, right? We're seeing a lot of diversification, which is a big point of narrative for the year, is keeping yourself diversified, because we don't really know where money flows during a war market. I'm going to take a wild shot in the dark. It's probably going to be energy and then healthcare, or vice versa. But we're seeing some of the initial tickers on that, right? Watch your 20-day moving averages, watch your 50-day moving averages, and then you can kind of see if there's a trend starting to happen. Bonds, commodities, and crypto. Bond yields rose because of on strong jobs data pressuring equities. Oil was still volatile amid geopolitical headlines, but retreated a little bit. Gold faced pressure as real yields climbed, and Bitcoin and Ethereum, oh my gosh, talk about a downturn today. Crypto traded with risk off, with Bitcoin dropping into the low 60,000, and I'm pretty sure it tapped 59,000 just for a moment, as well as Ethereum under 2,000. Like I'm seeing 1,700, almost 1,690 at some points, behaving more like a high beta tech asset this week. I don't know what's going on with Bitcoin, but I think I was anticipating it found a floor, but I guess it really wants to retest that previous area of 59,000 or so before it turns around. But Quantum Queso brought it up last week that we could be seeing 55,000 within the near future, even for just a moment. So I've got a little bit of hedging out on Kalshi for that, because it's easy to do individual price action on Bitcoin, but I'll bring all that up a little bit later, because there's some news in that regard that I want to bring up. Let me double check how the music's going for everybody. Oh, this is great. Okay, enjoy. All right, next we're going to be going into kind of a big news thing, as well as a big change for the overall trader industry and investors across the country. The PDT rule improvement came through on Thursday. Now, I mean, I'm not a conspiracy theorist or superstitious, just a little stitious. But it seems that every time we get something new that's going to help improve the ability for the little guys to kind of grow, the market just kicks them in the teeth like the next day. I cannot say where I get this from, or it's just a vibe, right? You see it, there's no evidence of it, but my gosh, I mean, it just started. But let's talk about what happened. So the long-hated pattern day trader rule officially is dead after 25 years. The old rule, which started 2001 around June 3rd till June 3rd 2026, the other day, in margin accounts under 25,000, you were limited to 3 day trades in a 5 business day period. Hitting 4 plus got you flagged as a pattern day trader, facing restrictions facing restrictions if you didn't have that 25,000 in equity in your account. But the new rules effective June 4th is no more PDT designation, no more counting day trades ever again, no more mandatory $25,000 minimum equity for frequent day trading, replaced with a real-time intraday margin requirement under the updated FINRA rule 4210. Brokers now monitor risk dynamically during the day based on your positions. Brokers have an 18-month phase-in period for this to fully update the systems, but many went live immediately, including Robinhood, within days or actually minutes of it changing. Robinhood, like I said, Webull, Interactive Brokers, Stacy Trade, and others removed flag/restrictions right after June 4th, like the day it happened. Schwab is going to start June 8th. E-Trade is going to start June 9th. But check your broker for the exact timing. I can't believe they're even starting later. What's your problem? Why would you do that? Who's that helping? The new minimum equity floor is around $2,000. Applies for margin accounts in general, but it's far lower than the old barrier. The reason this happened was the FINRA and the SEC recognized the old rule was just wildly outdated. Zero commission trading, better risk systems, and post.com era realities made the rigid $25,000 threshold unnecessary for many. The goal, more access for smaller traders, while still protecting against excessive risk via intraday margin calls. Now, what this means for you is if you have a smaller account under 25,000, you can now day trade more freely in your margin accounts without fear of flags or forced resets. Now, in cash accounts, you could have always done day trading, but there was always a bit of an unsettled funds buffer, right? You had like a day or hours before those funds came back, and then you could continue on with your trading, right? Depending on how your accounts worked. And if you were under 25,000, you tend to do things a little bit more risk on. But risk management is still king in the situation here. If you've never day traded before, it's a completely different animal. So you have to be really, really aware of the situation and your timing and reading the charts. I recommend doing some paper trading at first and then getting into it a little bit at a time. The recommended amount of capital you should be using on each individual trade is about 1 to 2% of your total portfolio anyway. So if you have a $2,000 account, or at least the bare minimum, you're looking at being able to trade $100 to $200 worth of day trading or futures or whatever it is. So that's something to keep in mind, right? It's always important to size appropriately, right? Just so you have the buffer of being wrong. We're wrong all the time. My gosh. Like, I'm like 50-50, right? You never know in this market, honestly, right now. Options and futures and other products may have still their own risks specific broker rules though, so get into that, look into that. It doesn't really affect me directly. That's not my vibe at the moment. If I'm going to do intraday trades or stuff like that, I'll just jump on Kalshi. Then I don't have to worry about a margin, because a lot of times I'm going to be future trading or intra-minute trading cryptocurrency anyway, or the future price of cryptocurrency. You can probably just do the S&P 500 there too, so it really doesn't matter. You can trade futures there on Kalshi. So I tend to use Robinhood as more of a swing trade, intra-quarter, something that I need more tool management over. Like, I understand that more than Kalshi, but Kalshi is a lot easier to get into, right? It's yes or no on whatever market you're trying to trade on. But as far as the PDT rule improvement, now it opens the door for more retail participation, but it also means new traders need solid risk rules, like I just laid out for you, to avoid blowing up on leverage. You don't want to be the person saying, I blew up an account. Like, I'm proud to say I've never blown up an account. Don't blow up accounts, okay? How's that sound? Like, how about just cut your losses? That's also cool too. The change is live for a lot of brokers, but like I listed, some of them have a couple of days out. But if you're under 25K, log in and check your account status. Always confirm with your specific brokerage, as implementation still slightly varies. Whew. That's going to be big for a lot of new traders, but I'm hopeful that we're going to see brokers ramp up the education for new traders then, because they deserve that. Because naturally you're going to get more liquidity in the market from people who don't know what they're doing, right? And that's just exit liquidity for people who do know what they're doing. So naturally the market is a lot less forgiving to the people who have less money. So it's important that you try to educate yourself. I hope you learn a little bit from the conversations you and I have here. And if you have any questions, by all means, drop them in the chat. I want to help you. And if you have any comments on what I'm bringing up, help me too, right? This is all a learning game. There's not really a competition here as a trader, right? Because we're both trying to compete against not going broke. That's pretty much the game, right? So helping you helping me, we grow together. And the sparked debates that we have online are important for the overall integrity of the information that we share. But next we're going to bring up a little bit of something interesting. So if you followed some of the pods I put out for the week, I tested out Claude by Perplexity. If you don't know what Claude is, it's a AI that's designed to also do agentic tasks. Agentic being like a body double. I can program it to go and do this, like set me up an email and send that email to somebody. Or go and look through all my emails for specific stuff. But what I'm looking forward to, and I'm hoping that you're looking forward to as well, is trading with agents, right? So Robinhood agentic trading debuted earlier this week. New traders like me, new agentic individuals, agentic exposed. Like, I know what AI is. I utilize it on a pretty large basis. Not because I'm lazy, but because I need information faster. My questions are more complicated than a Google search engine can provide. Generative information is going to be far more beneficial for the future than retrieval-based information. I wanted to customize the response to me. Now, I've used AI long enough to know what a hallucination looks like, or a confirmation response is, or a confirmation bias response. Because the app wants to keep you on there, it's going to lie to you a bit. So you have to understand what a lie looks like. So you have to practice like any other tool. So I'm going to be using Robinhood agents, and I got access earlier today, as well as all of the other traders who are on Robinhood. You guys all got access today. So like many of you, I'm going and teaching myself and learning how to do this with YouTube videos and asking AI, other AIs that doesn't cost tokens, because Claude, Perplexity, they have a certain amount of questions you can ask in a certain time frame before you have to start paying more money. That's okay. So I can sort of sandbox my questions in another cheaper app. and then move it into there after, and then work it a little bit on the cheaper side, right? It's all about trying to maximize your money. A lot of companies are having this problem. I brought up the other day that we had a CEO who had to pay over $500,000. No, yes, $500,000 for a single employee who used too many tokens. So be careful. Like, you don't want it costing you more than the information provided you in income. So I'm trying to keep my trading agent fairly simple. So look forward to those podcasts coming up as I attempt to set it and let it run on AI, right? You got to be a little bit wary and cautious, give it hard lines, like no more than X amount of trades in a day, no more than this much loss in one trade. You want to make sure that it never puts more than a certain amount of money inside of a trade, right? Because you want to make sure that the individual trading doesn't become too automated and robotic to the point where it starts making more risky decisions. I'm just checking the audio. Sounds good. But let's get back to Robinhood agentic trading. Now with Robinhood, they're letting you connect to a third-party AI like Claude, Chatbot, ChatGPT, Cursor, or other custom agents to a dedicated kind of sandbox Robinhood agentic account. Your main portfolio stays completely separate. You only fund the agentic account with what you're willing to risk. The AI can analyze markets, generate ideas, rebalance, and execute trades autonomously based on your instructions. Real-time push notifications for every action, plus instant one-tap kill switches. That is a huge need. Because I'm new at this, right? So I'm not going to put a whole lot of money there. I want to see how well it does. And if it does better than me, then I'm going to have a great summer. I'm going to move more money there and enjoy my day. Now, I already know what you're thinking. No, it doesn't do futures, it doesn't do crypto, and it doesn't do options trading yet. Just purely equities. So it's relatively safe for you as a trader, right? Because if you have a small account, you should start off with broad indices, try to stay away from individual stocks, that sort of thing. But if I have something as smart as a supercomputer, for instance, I think it can do a bit better than me with some rules, right? Like we do. We set up systems, but we as humans tend to shy away from those systems because of emotion. But with a robot, it has no emotion. It's really just going to listen to my instructions and follow it to the letter as best it can. And if it can't, then I'm hoping it'll just stop, and then I'll get a notification, and then I start over. I'm not quite sure how it's going to go yet. Let's see. What you do is you connect your AI agent via Robinhood's Model Context Protocol, or MCP. Open a fund or separate agentic brokerage account. Give high-level prompts. For example, maintain a growth portfolio with max 10% drawdown. Rotate into AI infrastructure dips, for instance. Right? This is a story you can give it now. So you can sit at home, you don't have to go on Claude. You can kind of write your story down and be like, okay, so I want you to find the best version of this, or follow trends. I want you to make 60% of the trade successful, right? No more risk more than this amount, right? So you can get as specific or as simple as you'd like. And the agent trades within your rules. No per trade human approval needed. They also launched an agentic credit card, which is a virtual credit card for Robinhood Gold members. So agents can actually shop, snag sneaker drops, book reservations, etc., with spending limits that you control. So let's say you wanted to find good flights. You can have this agentic credit card go and just kind of keep a radar going until it finds what you're looking for, whether it's over the course of days, months, today, who knows when it finds what you're looking for. And then you get a prompt, and then if you like it, then it automatically pays for it, books it, and bada bing, bada boom, there you're good, right? It can hunt for the best possible times to buy the tickets. It can hunt for the best possible discounts. It can utilize the best sites, like the stuff that you could never be able to do because of the amount of time it would take for us to actually search for everything. Because we want to think that if we go on Google and we type in find the best flights, that it's going to listen to you. It's not going to do that because Google needs to make money. So it's going to push the people who pay the most amount of money to be at the top of the search engine. But when search engines aren't really the way we look for things, things are now generated. The AIs wants to give you the best price, no matter who's giving it, because the AI wants to keep you using its platform. Right, so as you learn to navigate AI, you realize that it will hunt down the best possible information without bias, because the only bias it has is to keep you there. So it wants to be as close to correct as possible. Now, as far as Robinhood stock goes, it kind of jumped a little bit because of that, and that was kind of nice, but there are still a lot of things going on with pattern day trader rule change, as well as the agentic trading and agentic credit card. But this really solidifies Robinhood's want to democratize sophisticated automation that everybody can utilize, for every man, for every person. When I think about the future of what a non-job future looks like, I think it looks like this, where you research a good prompt, that prompt starts an account, that account grows money over time, and then you utilize the capital. Because you could say, I would like a high yield dividend agentic trading account where it finds the best way to gain you income. Why not? And then it trades with the idea to make you a living. And then all of a sudden, there's really no need for you to get a job, right? That's sort of what I do. Hang out here and talk with you and all of the other people on the internet, trying to gain information from each other so we can all grow our equities. But eventually we'll have an agent that kind of does a lot of that heavy thinking for us, and we just agree or disagree. Now, there are some risks, and here are some guardrails as well, which are very important. This is still beta. Expect bugs and a bit of a learning curve, as well as AI can and will lose money. Agentic accounts carry full market risk, and performance depends heavily on the agent's smarts and your ability to give it a good story. Regulatory questions remain around liability when AI trades go wrong, right? Who's to blame? So you gotta kind of treat it like a stupid employee that you have, right? Who's very, very smart, but follows instructions to the letter. Like, they don't have any leeway here, right? So if you don't give it clear instructions, you're gonna get a very bad trade out of your agent. Like, I'm pretty sure if you used AI ever, AI has led you down a wrong path. I know it has for me. It's led me down a terrible path a couple of times, right? So I've learned over my numerous times using AI to double check its validity with other AI, or just kind of double check the bottom line if it matches up anywhere else in other people's theses and thinking. Now, this is still a massive leap forward for agentic finance. Vlad Tenev and the team are clearly positioning Robinhood as the go-to platform for the AI native investor generation, which is you and I, and hopefully the generation coming up after us. If you have tried it already, just drop me some comments on the early results that you have, or if you know of any horror stories. Now, the horror stories get a lot of movement on X, and I can never believe them, but I can see that some of the agents are down, and people want agents to be spot on every day. I don't know if that's possible, right? They're still trading the same markets we are. If you didn't give it enough conditions, or even if you gave it too complicated of a story, like what if it has to check too many prompts before it can make a trade? Or why are you like, is it making 10 trades a day? Or like me, I want it to make maybe at the most 4 trades a day, maybe at the most 20 trades a week, right? With a risk of 1 to 2% of the total capital that it's risking per trade, right? That seems realistic, and I want to give it the themes, which is the 3 R's, right? Who's receiving money, who's... I'm not going to go into it because honestly I just forgot it. But also you want to remember where money's going, right? Who's spending, where money's going after that. But I really want to make sure that whatever I'm trading is kind of following the overall macro idea, right? I want to tell it that oil is up. I want to tell it that diversify, because that's important. I want to tell it to keep an eye on energy, because that's sort of what's coming. I want to tell it to keep an eye on healthcare, right? So I have to kind of craft this story in my head before giving it a prompt, because prompts cost tokens, and I'm not over here trying to be a token maxer. But speaking of digital tokens, Bitcoin price action, let's get into that for a second. So it was a bit of a brutal week. Key testing, key support was in check and in play all week. While equities saw a tech-led sell-off, Bitcoin stole the spotlight for all intents and purposes, and for all the wrong reasons, posting its worst week in months with a sharp 15 to 18% drop. It started the week around 73,500 and closed Friday around 59,800. Peak to trough move of over 14,000 wiped out in days. That's just hundreds of millions out of the crypto market. Poof, longs liquidated. Heavy liquidations topped 1.1 billion in a 24-hour period as leveraged longs got flushed out. Now, this happened literally the day after the pattern day trader rule change. So I'm hoping not a lot of new investors got caught in this crossfire. But honestly, I don't know. This market downturn was kind of overblown. Like Nvidia down like 3 or 4% on the day. That's bananas. I mean, lots of things took a hit, from XRP down 5%, Solana down 5%, HBAR down 4.5%, BNB down 2.9%, Link down 6%. I mean, everything down. Record ETF outflows, spot Bitcoin saw billions in redemptions, one of the largest streaks on record. Macro pressure, strong jobs data, higher yields, risk off move across crypto was sort of the way it went. Profit taking and whale sales, long-term holders reduced positions, headlines around corporate holders like Mr. Michael Saylor. Like, he sold what, like 30 Bitcoin, and y'all lose your minds? What was that? That's such a wild reaction to this small amount of selling. Now, I don't know why he sold, and he's been a pretty big advocate for not selling your Bitcoin, right? So when he does that, I guess the markets get a little bit crazy. I don't know. Personally, I don't care. If you're trying to just make money off of Bitcoin in the short end, trade the price action through some sort of exposure. Don't trade, like, just buy more of the actual Bitcoin if you're going to buy more. Like, it's a long-term idea, right? And this is a pretty good area to start picking up a little bit more. As I said, we saw a strong flat, so that's sort of a floor. Maybe we're testing, there's a hole in the floor that we're testing, and we're going to come back, and then maybe we're going to be on our way back up. But you cannot fade the cycle, right? Bitcoin's on a 4-year cycle, and we anticipated we'd be in a Bitcoin or crypto winter, and surprise, surprise, here we are. Now, technical levels to watch is the immediate support of 58,000 to 60,000. It's a psychological zone, right? you and I, maybe we trade small little individual dollar amounts, but big institutions and big whales, they trade on hard lines, right? Hard even numbers, because they can just type in buy 10,000 at 60K. Done, right? They're not over here trying to scalp. Next major support is potentially 55,000 or lower. So I'm thinking it's going to test that 55,000. I mean, we have not had a good year for crypto, and it's really testing the conviction of the long-term crypto holders. Now, I'm sorry to the people who bought at 126 and never bought again. You're down like 70 or 80% from peak to trough. It's insane, but that's okay, right? But your trading is cryptocurrency, and that's naturally a volatile thing, right? And if you didn't notice my hat, you're supposed to hodl. Duh. But the outlook is, this is a kind of a painful flush out. But on-chain data shows no widespread panic from long-term holders. Many are still hodling. Historically, post-halving years see volatility like this before stronger moves. With the new PDT changes and Robinhood's agentic tools live, retail access is higher than ever, which could fuel faster recoveries or faster liquidations. Hope springs eternal, but hope is not an investment strategy. But the bottom line here is short-term bearish momentum, but many see this as a healthy, if not painful, shakeout in a still intact longer-term bull cycle. Watch the weekend price action, I know I will, and next week's macro data kind of closely. Now let's talk about Kalshi for a second. Whew. That was a lot going on. How are we doing on time here? 8:41, 40 minutes in. I'm going to double check the audio for you, for me. Oh, nice. This is great. Okay, so Kalshi this week introduced perpetual futures. Now, if you don't know what that is, I'm pulling up some info here, so excuse me if I'm split-brained. But here's another game changer, right? So Kalshi developed development that ties perfectly in with the pattern day trader rule and all this agentic stuff. Kalshi just became the first US platform in history to offer regulated perpetual futures, or perps. So the announcement came in earlier in the week, and Kalshi launched perpetual future contracts fully CFTC approved. First contracts went live, which was Bitcoin, on June 3rd. Like, all this came all in the same time. Like, it's funny to kind of watch all of these big people and big industry leaders fight for all of our money, right? You realize they're fighting for all of our attention, right? If you're trading on Kalshi or you're trading on Robinhood, I'd like to utilize both, because I find that tools in a toolbox is what I find them as, I guess, if that makes sense. Because I can use this tool for this thing and this tool for this thing. Short term, I tend to use Kalshi. Long term, I tend to use Robinhood. It just fits my brain a little bit better that way. The UI for Robinhood just fits my brain as a long-term outlook. The UI for Kalshi fits my brain as a short-term swing because of the way it's designed, which pumps my endorphins, which is good if you understand how endorphins function in your own trading style, right? Because I know if I'm overly excited, I'm probably wrong. But back to Kalshi for a second. This marks Kalshi's evolution from pure prediction and events contracts to full-blown derivatives exchange. Here's what perps are. Perpetual futures are leveraged directional predictions on asset prices, mostly crypto so far, with no expiration date. So these are timeless, right? Just like a stock. You buy it and it gains or loses worth until you sell it. You can go short or long. Funding rates every 8 hours keep the contract price aligned with the spot price. Cash settled, CFTC regulated, and available to US retail traders, with leverage up to 6.3 times on Bitcoin, lower on altcoins. note on that amount of leverage. That is a dangerous amount. So if you have $1,000, you can trade $6,000 worth of money. So if that $6,000 starts to go against you, just 20%, you've already wiped out your $1,000 by double, right? Because 20% of 6,000 is $2,000, right? So 10%, 15%, somewhere in there, and you're wiped out. So you got to be very careful. If you're on the wrong side of the trade, and I'm wrong a lot, but I'm so profitable, you got to know that if you don't have the amount to be wrong, like you can't cover the margin, that's it. All of your equities, toast. Be careful with leverage. Don't F with it if you don't know what the hell you're doing, and if you're not fast enough to get out. Ugh. But responsible trading only, right? Now, available at launch was Bitcoin, Ethereum, Solana, XRP, and Doge, with plans for additional assets pending CFTC review. Why this is huge, though, it brings trillions in offshore perp volume onshore and it's regulated. Offshore perps hit a little less than 90 trillion annual volume recently. Pairs with the new PDT freedom, smaller accounts can now experiment with leverage more easily, but risk management is critical. I cannot express to you how important risk management is. Like, preservation of capital is important. Now, we all took a bit of a hit today. Like, today wasn't great for literally anybody. Well, my SanDisk shorts, the 2x leverage SanDisk, those are actually up like 20 or 25%, which is hilarious. Now, I don't have a huge position there. I kind of threw those out as long shots, but it makes sense. Like, SanDisk, it should be down somewhere in the 500 areas, to be completely honest. That's where I'm seeing SanDisk at. Alright, so it competes, but as far as the Kalshi perps go, it competes directly with offshore platforms while offering US traders legal access, better protections, and integration with Kalshi's existing prediction markets. Here are some takeaways and risks, though. Volume potential, like, it's massive. So it's easier to get in and out of a high volume market, right? So you can take those 1 penny differences or 1-2% differences if that's how you trade. Many see this as a land grab for US crypto derivatives, though. Guardrails, leverage is capped, lower on some offshore than some offshore venues, and it's fully regulated. Here's some caution, though. Perps are high risk, high reward. Funding rates, liquidations, and volatility can wipe out positions really fast. Like, wipe out. Paper trade. Just paper trade. Especially in the current Bitcoin sell-off environment, I can imagine the first-time perp traders or the first-time pattern day traders, they're gonna have a shit weekend. Excuse my French. Would it be shite? Nah, it doesn't matter. Because they got excited, they waited a long time, they got into the market, immediately got slapped in the face, and now this weekend and the first weekend of June is bad for them. And it still goes back to my suspicion, conspiracy, I don't know, superstition, that big money wants to push out little money so that you feel degraded enough to just invest in their ideas. And then the market moves the way that big money wants it to move. Like, we forget how big our movements are, and they're not hard to miss. Like, retail traders or everyday traders, depending on how you want to reference us, account for about 20 to 30% of the total trading volume in the US, as far as I know, and that's huge. That's a third of the overall S&P 500 moving because of you and I. Not because some guy in a Wall Street office, not because some huge hedge fund, because of you and I and our ideas, right? So it's not super hard to imagine a world where they try to shake us out a little bit more than we deserve. Like, we deserve a place at the table, and that's what Robinhood provides, I feel. But on the volatility and crypto, there's a little bit of a sad news. Zcash. I don't know if you remember from earlier in the beginning, I talked about Zcash, but Zcash, or ticker symbol ZEC, took a huge dive. The privacy coin king, or was it a volatility victim? I don't know. But in a week dominated by Bitcoin flush and broader risk-off moves, Zcash stole headlines for all of the wrong reasons as well. After a monster run in May, it suffered a brutal 40 to 50% downturn in 48 hours. Here, let's break it down. So it launched in 2016. Zcash is the original zero knowledge proof privacy coin. It uses ZK-SNARKS and a newer Orchard shielded pools to let users choose transparent transactions like Bitcoin or shielded transactions, truly private, sending receiver and amount are hidden. This optional privacy model sets it apart from Monero's mandatory approach. It's given Zcash better exchange listings and institutional interests, but critics argue it can compromise fungibility. So the recent surge was early in 2026. Zcash exploded higher, outperforming Bitcoin dramatically at points, up over 1,500% versus Bitcoin in prior 12 months at peaks. It hit a fresh 2026 high near $620 to $680 in late May, early June on major catalysts. But the key trigger was the SEC closed its long-running investigation into Zcash Foundation with no enforcement action, combined with strong shielded adoption and institutional accumulation. It fueled a bit of a massive short squeeze. But on June 5th, which was today, the critical vulnerability in the legacy Sprout Orchard shielded pool, potentially from an unlimited counterfeit Zcash that was disclosed. So developers pushed an emergency fork, but panic selling recorded record shorts and loss of confidence sent Zcash from $620 or more down to $300 levels intraday. It's since stabilized somewhat around $350 to $390, but the big okay, so that was very complicated. So I'm going to just break it down really simple for a moment before I move on. Zcash is just like any other cryptocurrency where you can trade it on the blockchain. But the way it differed is you can either keep your transaction public, where you can see it on the blockchain and trace it wherever it goes, or you can privatize it, where you don't see anything. You don't see the amount, you don't see where it went, where it came from. But there was a way that Claude discovered that people could mint an unlimited amount of Zcash that was untraceable, right? So because of that, we have no idea how much Zcash was minted fraudulently, because they most likely did it privately. So if you were to fraudulently figure out a way to print Bitcoin is on a blockchain that can never be private. So you would see where these fraudulent coins were minted. But because Zcash has got a privacy option, we don't know how many moles are inside of this building, per se. I don't know. So the circulating supply is about 16.7 million. 24-hour volume extremely elevated in the billions, mostly selling. Market cap 6 billion. My God, that kind of makes it very sketchy for a lot of newcomers or people who want to onboard people into cryptocurrency, because this will definitely make the national news at some point, especially in news outlets who don't like cryptocurrency. And I can't blame them when something like this happens, where you can just mint more on the privacy side of the chain. I don't invest in Zcash. This just came out today as news, and I needed to share it with you because this could affect the overall market. Now, the bull case for this, which I don't see, is I don't even know why I called it that. Regulatory clarity. The SEC closure removes the major overhang. Now, this was fixed already. Before this came out, this was already fixed. This was people selling because we don't know how much fake Zcash is on there. Institutional pipeline, Grayscale Zcash Trust, ETF discussions, mining pools, and big holders. Like, are these the things that are going to keep Zcash alive? Like, we're going to see over the weekend. Upcoming upgrades, target shielded assets, faster blocks, and quantum resistance are coming along. Privacy narrative, growing demand, even though stuff can happen in the dark. Strong treasury and ecosystem is still there, right? This is still a pretty good coin. This is just hit a bit of a roadblock. I'm glad it's fixed for the overall holders. I'm seeing like major holders, so like Get Rich Nick or Choose Rich Nick, excuse me. He sold his position in Zcash today, I saw. So I mean, that's gonna move a lot of the altcoin market if they see that at all. Because if Nick is out, why be there at all? Here's the bear case, though, the more likely side. The bug exposed a real concern about how these privacy tools can be manipulated. Confidence will take time to rebuild. Classic privacy coin behavior, though, massive pumps followed by sharp down draws. Even if this wasn't because of the Zcash ghost minting, we're just going to call it ghost minting. Because you have no idea if you're trading because it doesn't matter, because they're still going to trade like a regular Zcash. So it's like minted perfectly. It's not like counterfeiting money where you got to get certain materials to counterfeit a dollar bill, right? To counterfeit a coin, apparently you just copy it, I guess. I don't know how this works. I'm not going to tell you how it works.
Hey guys, this is Joe Kudla, founder and
Don't
CEO
do fraud.
of Yori, and today I want to tell you about one of our
I shouldn't have to tell you guys that, but don't do fraud. There's still some regulatory pressure on privacy coins, because it still kind of remains a gray area globally. But the outlook, this crash feels like a classic shakeout after a parabolic move, even if that overall fake minting or ghost coin minting was a problem. The fundamentals haven't vanished, but the near-term path depends on how quickly the community rebuilds trust post-fork. That's hilarious. Support zones around 250 to 300 are being watched, so if you're looking for a position in Zcash and the thesis long-term works for you, we might be looking at an area for you to pick up more. A reclaim of 500 plus could flip the script to bullish again. Zcash remains one of the purest plays on financial privacy in crypto. In a world where that's increasingly valuable, it has an asymmetric possibility upside, but it's not for the faint of heart, for the lack of a better description. If you have a take on that, by all means drop it in the chat. If you had to sell your Zcash, let me know. I want to hear your breakdown on that, because I personally didn't have to. If I saw this happening to something I held, I definitely would have trimmed that position hard, for sure. Whew. That was a lot though, right, guys? I really enjoyed it. This was a great pod. I'm getting the lingo down a little bit better for you. It seems the music cut off at some point during the pod, but that's okay. We continued on with our cadence. I hope it wasn't too long that it dropped out on you. But we kept the motions going, and if you like the music, let me know. I'm going to come to a close here in a second, but I want to make sure that I get a word from our sponsors. All right, welcome back. Thank you for sticking with me and my ad. If you need relaxation, please give us a call there at the Kohala Salon. They're ready and waiting to take care of all of your summer relaxation needs there at the spa. From facials, haircuts, styling, products, makeup for events, blowouts if you just want to look good for dinner, we cover it all. Nails, hair, face, we got you. Now, here are some takeaways from the day because we covered a lot of information. What a week. We saw fresh all-time highs in major indices, getting slammed by hot jobs report, sending yields higher and triggering a sharp tech rotation. Bitcoin got absolutely hammered, dropping to a new low of 60K or lower with heavy liquidations. But the bigger story was the infrastructure. The PDT rule is officially dead. Robinhood dropped agentic trading into beta, and Kalshi launched regulated perpetual futures, all in the span of days. Retail trading just got a massive power up, like that Mario mushroom, right? I don't know what that mushroom's called. If that mushroom has a name, let me know. But it's like we went from that little Mario to getting that boom, huge Mario action. But we also broke down a little bit of Zcash. I hope that helped you if you see this news coming up. Don't be afraid. This isn't something that all coins go through, and they fixed it. It's a textbook example of crypto's wild asymmetry, though. Regulatory clarity and a huge run, followed by a shielded pool vulnerability that triggered a 40% to 50% downturn. Privacy coins still remain high conviction, high risk assets. The tools are getting better and more accessible than ever, but the market is reminding us that volatility never takes a day off. Risk management, position sizing, and clear rules, especially with agents and perps that are now live, are non-negotiable. Keep your rules in line, and if you need rules, go and ask your AI to give you rules that other successful people use. If you know of a company that trades really well, why don't you just use their rules, right? If they have lines, stops, losses, pluses, right? Find the rules that work for someone else, and they're probably going to work for you, especially if this person has more money than you, because then they've tested these rules out already. Now, verify who you're following, of course, because you don't want to be following some fool who's lying to you or some random guy on the internet like me. But the accessibility to the market for retail traders has never been better. But the market is reminding us that volatility is still around, like I said, so you got to be very careful. Whether you're day trading, because now you're even freer as a day trader, or letting AI agents run parts of your portfolio like I'm trying to do, or even hedging on Kalshi perps or hunting dips on names like Zcash. You have to stay disciplined. But that's a wrap for this week. A huge mahalo for tuning in wherever you are, whenever you are. If you had a favorite part of this pod, please drop it in the comments. Like and subscribe if you have a want to continue with this journey that you and I are on. I read every single comment that comes up, and I respond to all of them, from hate to love. So if you have any questions, drop it in the pod or drop it in the chat. But as always, farewell. Ahui ho. Please stay safe. Drive with kokua. I'll see you soon. And as well as I'll see you on the porch and in the markets. Have a great weekend. I'll most likely see you Sunday and upcoming live pods and not so live pods coming up next week. Love ya. Be good out there. Remember, risk management.